Okay, so today we're going to talk about Bitcoin and how the Bitcoin system works. So I started you out with sort of at the higher level what a blockchain is going to need. And now I'm going to go through how are they specifically applied to a system like Bitcoin. So I'm going to go through some precursors. What are the things that have been developed that have led us to the way Bitcoin is today? The first thing is ledgers. Ledgers are these things that have been around since early 3000 BC. And they're used to record things like record transactions for like barley and payments. And one of the nice things about ledgers is it reduces the errors and makes the system more trustworthy. Some examples of these in history are things done in clay, which is on the right, or things that are done on scrolls, papyrus scrolls. Another thing that's important is this notion of double entry bookkeeping. And the idea of this is to manage accounts so that any of the debits have equal and offsetting credits. And this is to make sure that everything has been accounted for on a balance sheet. And this is typical, like if you go to an accounting, if any of you are eventually going to go into an MBA and then maybe take an accounting class, this is sort of the heart of accounting. And this was developed in the 1400s. And it ensures the integrity of the ledger. So it ensures that all the money has been accounted for in a system. And so parts of this kind of bookkeeping, there are original records, which are the transactions. There's a classification of those records. So are they debits or are they credits to your account? And you'll see this in a bank statement that you might get, where you have the different classifications of the transactions to your account. And then for a business, profit and loss would be in part of the bookkeeping. So this is an example taken out of an accounting site where this would be a balance sheet a business might produce every quarter to talk about their assets and their liabilities. And so these things would offset each other, and then you have your net that can be calculated from that. Your income and expenses are another one of these, and this shows you your net profit. So this is the kind of accounting, the financial accounting that you would want on a system that keeps track of money. But one of the problems with ledgers is that they're centralized. There is implicit trust that the person managing the ledger is being truthful. So this is a funny cartoon that I like. If you think about it, there's many cases through the course of history where the books have been cooked. And that's a term that, are all you familiar with that kind of term in financial accounting? But the idea is that someone keeping track of the ledger can easily play games with the numbers and show a profit when in fact there's an enormous loss. And so some of the examples you might have, well, I lived through, but I don't know if you might be too young to have lived through. 2001. So Enron and the Arthur Andersen scandal. Arthur Andersen was the accounting firm for Enron. And Enron was playing all of these shell games with these subsidiary companies to always show massive growth. Massive growth. And then eventually, when it came to roost in sort of the crash, the whole thing folded. And then Enron went bankrupt, and all of its shareholders lost all of the money that they had invested into this company. Another example of this was this you probably lived through, was Lehman Brothers in 2008. So this was one of the precipitating failures, the bank failures that led to the 2008 recession. And they were cooking the books. In fact, that's why I put this article in here, because that's the term they use. They were cooking the books far more than we ever imagined. They were hiding all of their losses to try and pump up their stock, and then that whole thing fell over. And then this is what we're living through right now. GE, if you followed the news, GE is in severe trouble here. They have a $38 billion accounting problem. And they were able to hide it for a long time by, well, allegedly cooking the books. This hasn't been proven yet, but I think there's smoke here near this fire. So this is a problem, right? So if people in developed nations can't get their books right, how can other countries do the same? So centralized bookkeeping has this trust issue. And even if the bookkeeper is trustworthy, what happens if someone hacks into one of these companies and just deletes the ledger or deletes the books? You have that problem. So you have adversaries or maybe even disgruntled insiders that can actually tamper with the ledger intentionally, even if you're trying to run a legitimate operation. And so this motivates the need for a decentralized ledger that's tamper-resistant and that is replicated, right? You want all of these things to try and address some of these issues that we saw earlier, okay? So a shared ledger of synchronized, authenticated digital data kept and maintained in a decentralized manner, cryptographically secured. This is what you would like to have. Okay. The next precursor I'm going to talk about are currencies. So currency is the direct settlement of transactions via an untraceable exchange of money for goods and services. So again, from 3000 BC, typically this revolved around precious metals. So you would exchange gold for services, for agricultural products, for example. And then this was adopted by many of the ancient civilizations, using precious metals to exchange for services. In the US, almost immediately when we established Congress, we established a legal tender for the US, and it was basically based on gold and silver. So you had gold coins and silver coins, and these things established a fixed price between that gold and a notional US dollar, and the US Mint has this fixed rate between gold and silver that is a relative valuation of these precious metals. And this is how we transacted in the 18th century. In the aftermath of the Civil War, or as the Civil War was being sort of pursued, we had the inability to pay debts using our existing gold and silver, and so the U.S. adopted paper money as legal tender. But it was still tied to the actual precious metals, but this is considered a fiat currency, where you're not actually using that precious metal to do the exchanging. And then eventually silver was removed from circulation in 1873. This is why if you ever have those silver pennies, like those are super valuable, because that was back at the time when we were actually using actual precious metals in the currency. So in 1900, they basically had this notion of moving the precious metal into a reserve and then issuing paper dollars on it to represent, because it became impractical to just exchange using the precious metals. And so this was established in 1900. Worldwide, in the aftermath of the World War II, the gold standard, where you were pegging your currency on the gold that you had, was wreaking havoc with companies that were, or with countries that were trying to recover from the war. And so this was one of these seminal points in history where they decided to do this global exchange, where the price of gold was fixed to the US dollar. Because the US had the strongest economy, they decided to peg that to the dollar, and this actually made US a global superpower in the aftermath of World War II. Okay. But there's an issue with using precious metals and pegging your currency to that metal. And so one of these economists, John Maynard Keynes, says that, posited that it was going to be difficult for you to react to severe economic situations if your currency was pegged to a a metal like this. It was an inflexible mapping between your currency and the gold reserves that you have. And so in 1971, this was very controversial. Nixon decided to drop the gold standard in the financial fallout from the Vietnam War. And now, for the first time, the government controls the scarcity of the currency. And this sort of led, because we don't know how to manage an economy where we get to print how much money is out there, this led to things like this huge inflationary period where we were printing too much money in the late 70s, and then it caused some other issues in our economy. So many people believe that this was problematic, and we're still trying to get this right. How much money do you print to keep the thing going without it all falling over like a house of cards? Okay, so this leads us to digital currencies, and the first version of a digital currency was this thing called DigiCash, and this is a secure, anonymous digital cash proposed by Chom. Chom wanted the benefits of online transactions without the drawback of the transactions being traceable. So at this point, credit cards had taken off, but the thing with credit cards is that the credit card company sees exactly where you're buying stuff. So he didn't want that. He wanted a way for you to get towards cash in a digital way. So like currency, like real dollar bills aren't really traceable. You want that in a digital form. And so he created this thing called DigiCash. And so the model is that the users will obtain this digital currency from a bank, but that the bank is unable to trace the expenditures of this currency. And this is done through something called blind signatures. And I'm going to treat the blind signatures as a mathematical abstraction here, because the math is not something I'm prepared to teach. Just like everyone else, I'm going to assume that this is magic. The math is magic, but I'm sure some mathematicians in the room can dig into the actual details of this. So at the highest level, there is a bank with a private key, S prime, and this private key will sign anything. And anytime this private key signs something, it signs something that's the signature is worth $1, let's just say, in his system at least. And then the payer with an account at the bank will create a single $1 note by asking the bank to sign something. And as part of this, when I ask the bank to sign something, the bank is going to debit $1 from my account. And then I'll have this signed note that is worth $1, because the bank signed it, that I'll retrieve from the bank. Okay? The key is that I have to blind it. I want to blind it so that the bank can't tell that this particular note was issued to me, right? Because if the bank knows, oh, I'm signing this note for this payer, well, and I know I've debited $1 from this payer's account, if I have any information in that note that identifies the payer, then I can trace the thing. And so this is the problem that Chom is trying to solve. So I need to blind the note that I get the bank to sign, and then I'll get it signed by a bank, and then when I get it back, I can do this operation that unblinds it, that actually gives me the actual currency. And I'll step through this a little bit later. And then I'm going to provide that to the payee. So I'm going to go to someone else and say, hey, I want to spend my $1 that I've gotten from the bank. Here's my $1. And the payee, who also has an account with the bank, the payee is going to say, hey, bank, this person's trying to pay me with this $1. Did you sign this $1? And the bank is going to say, oh, yeah, that's my signature. I've got, that's valid. I am going to take the $1 that the payer withdrew, and I'm going to credit it to the payee. And I'm going to do that in a way that I can't trace that note. Okay? So then the bank will update the balance. Okay, that's the highest level. I'm going to dive down into the details of this. There is this special commuting or blinding function, C of x. And I actually have I'm going to need to pause. I have an out-of-date version of these slides here, which is way more confusing. So hang on a second, bear with me. Okay, so S prime is this signing function. So it's basically the bank's private key. And then S is the inverse of S prime. And this is just what we talked about with digital signatures, so that S of S prime of X will give you X back. And then you know that, yes, I have signed, the bank knows it has signed this particular piece of data. So the special blinding function is called C. And the magic of C is that when the payer applies this blinding function to some input X, like the banknote, or the currency note, and gets the server, the bank, to sign this note. When it gets this signed note back from the bank, the payer can apply the inverse of the blinding function to unblind it to get back a signature from the bank on the original X. Now, the bank never sees X. The bank only sees this C of X. So this decouples the bank's knowledge from the note. But the bank eventually, if the bank gets this S prime of X, because it has its own, it can verify its own signature, it knows that it has signed this thing in the past. But it can't tell which payer it signed it to. That's like the whole magic of the blinding function. There is also this thing called a redundancy check R. So in order for the magic of the blinding function to work, there's this thing where R, in order to have a special X that actually has this thing hold, there are certain properties of X that have to hold in order for this to work, and that is represented in this redundancy check R. And so R, when you apply it to X, will tell you whether or not that's a valid input X for the blinding function. And this is basically an integrity check on X that's going on. Okay, so this is the process. The payer randomly chooses a note X such that the redundancy check holds for that particular blinding function, and then it gives that blinded note to the bank to sign. The bank signs C of X and returns the signature, the signed version of this blinded note back to the payer, and then debits the payer's account $1. And then the payer needs to make sure it never loses that note, because that's a live $1 bill that it now has. When the payer wants to use this note, it'll unblind the note. So only the payer knows C prime, so C prime is applied to yield this signed note S prime of X. And then the payer is going to check that the S prime of X is valid by applying the bank's public key. So you want to make sure that you got your thing signed by the actual bank. And so if you know the bank's the public key, you can verify that S prime of X holds by applying the bank's public key on the signed note to make sure that, yes, I did talk to my own bank to get this $1, and it's going to work for me to spend it. So that's the additional check that the payer does. You could actually do this right when you get the signed note back, but in this case, you can do it right when you pay as well. Okay, so then the payer says, I want to give that note to a payee, so I'm going to just send the payee this S prime of X, and the payee checks to make sure that's a valid note by making sure it passes this redundancy check. It also makes sure that it can generate a valid S of S prime of X, because this is the bank's public key. And so if I've presented S prime of X, the payee can say, yes, our bank has signed this note. It's a valid note, and I can give you your $1 worth of goods, knowing that this is a valid note that I can cash in on at the bank. So then the payee is going to forward S prime of X to the bank to say, hey, you know what? This is my proof that the payer wants to transfer me $1. And then the bank is going to add S prime of X to a log of notes that have been spent. because you don't want to do double spending, right? Like if someone else gets S prime of X, someone else could also replay that transaction and try and get another dollar. So the bank does keep a log of all of S prime of X's that have ever been spent, and to avoid double spending, but the catch is that it never knows who this S prime of X belonged to, because it was blinded up front when it was issued. So that's the magic of DigiCash. And this thing in the 80s, this was so revolutionary that Bill Gates was like, I want to include this in every copy of Windows, and I want this to be the digital payment system that we use. And that's big. If you install it on like what 90% of the world is running on a computer, this is big. But there's a nice history, if you read the history of this, of how it fell flat. And it basically had nothing to do with the technology. It had everything to do with people wanting money. But that I won't go into that. Okay, so then that's what happens. The bank makes sure it's a valid note. It checks its own signature. It's like, oh yeah, I did sign that thing. And then it checks the log of spent notes to make sure it hasn't appeared. And if all of those things are true, then it adds that note to that list of spent notes, and it gives the payee $1 in the payee's bank account, and it tells the payee, yep, you got $1. Go ahead and give the payer what the payer wants, the $1 of transactions. Okay. Any questions about that? I just threw that in there because it's really interesting. It's not being used anywhere, but it's a really interesting solution to the anonymity problem. And anonymity in distributed ledgers is a big thing. Yep.
How would it know where to take it out of? You have the bank, you have the transaction.
It took it out right at the beginning. It says, hey, I'm going to sign a note for you. That's cash that has been taken out of your account. So the bank has its own money. So it was credited to your account. As soon as I sign that thing for you, I take that dollar out, and then hopefully that dollar is still there when the payee says, hey, this person spent this dollar, and then it goes. And that makes it untraceable. You don't know that the only people who know that this particular payer and this particular payee had a transaction are the two payer and the payee. The bank doesn't know because of the ambiguation of the blinded note. Okay, another system that came about a decade later, and this was another thing that Bill Gates was like, I got to have this on Windows. It's got to be in all of our email exchanges. There's this thing called Hashcash, and this was a defense. Back in the 90s, we were getting spammed like crazy. Like if you had an inbox, you're getting like 90% of it was junk mail. And so this was an issue that a lot of providers were trying to solve. And Adam Back created this system where he decided what happens if the sender is forced to add postage, some kind of computational postage on the email that sender sends before the recipient will receive that message into the inbox. So this is the problem with email, is that a sender, without consuming any resources, can load up a server with all sorts of messages and force the server to store them. So this kind of asymmetry of resource consumption is what you want to get out, remove from client-server systems. Because typically the server's doing all of the work, and if the client is able to unabatedly access the server, you can bring the server down. So that's a typical denial of service attack. And spam is basically a denial of service attack on email. And so his system was to find a solution to a difficult proof of work puzzle and use that as postage. You would attach that as postage to your email. And this solution should look familiar because Bitcoin lifted this solution for its proof of work algorithm. It's you find some nonce X where SHA of your nonce and the message is less than capital Y. And it has, in particular, a certain number of 0 bits, right? Because the size of you want this thing, so if this is, so if your input space has 160 bytes and you want less than Y to be 150, 1 byte of zeros and then 159 bytes of anything, then this would be a postage stamp that would force that sender to do at least 16 hashes in order to send that message. So that's the idea. So this is basically the proof of work function used in Bitcoin, except for Bitcoin is using a different hash function here, is what you're doing. So this leverages the avalanche effect of the hash function, not really pre-image resistance. I should update that, mostly avalanche. Okay, the next precursor are decentralized networks. And the first example of this is Napster in the late 90s. This is a peer-to-peer file sharing system to exchange MP3 files, audio MP3 files. And this was really one of the first decentralized applications where all individual users, like you or me running this client, would create the application. So the idea is that I keep a central registry, the Napster server, and every time a client signs into the app, it registers with this central server, and it gives the server an index of all the data files that are on that are available for file sharing on that computer. And then the central server has this directory of files, and then all the clients, when they search for a file, will ask the central registry to find the client who has that file, and then the exchange itself is going to go peer-to-peer. Clients are going to directly connect with each other. So the peers are actually storing copies of the files. But it is decentralized in the data plane, but because there is this central registry server, you could easily take it down. And that's what ended up happening. So you would just have to attack the registry server, and it makes censorship, quote-unquote, censorship trivial. And so a single judge ordering it to be shut down forced Napster to go out of business. So this led to people developing more distributed versions. They wanted the control plane and the data plane to be decentralized. And Gnutella is the next version of this, or an alternative version to this that gets rid of the centralized registry. And the idea here is that you form an overlay network dynamically, and you have the notion of neighborhoods where you're trying to discover all of the other Gnutella peers that are close to you, and you would do some broadcasting, and you would do some sort of directory services between these nodes on a peer-to-peer basis. And the thing with Gnutella is that it couldn't be shut down. There is no one central place that you can go to shut Gnutella down. So it's really truly peer-to-peer. The only way you can really block it is to block all of its ports. And even if you block all of its ports, it's easy enough to take that protocol and try and shift it over a port that you're never going to block, like port 80, the web port. The other thing with this is that the protocol and the source code are open source, so it makes it really difficult to then sort of restrict the ability to run Gnutella. Okay, the next system is BitTorrent, and this is a file. So BitTorrent is still heavily used today. It's a peer-to-peer file sharing application for large files. And what this does is that rather than creating a static peer-to-peer network, this thing creates a dynamic, an on-demand peer-to-peer network based on the file that you're trying to distribute. So there are nodes with full copies of the file that you want to distribute, and they're called seeds. And they altruistically allow others to download parts of that seed file, the original copy. The innovation of BitTorrent is nodes that are downloading a file are automatically allowing other nodes to download the parts that it already has. So this is one of these share and share alike kinds of things. As you're getting benefit from the network, you're giving benefit to the network. And that incentive structure allows the download rates to be really high because everyone's participating in the distribution. So that the notion of you just downloading from someone and not giving anything back is this notion of freeloading. This thing gets rid of freeloading. And so this incentive system, if you think about incentive systems, this is a primitive way of doing the incentives. Bitcoin is much more explicit. It says if you participate in my network, I'm going to give you cash, cryptocurrency, digital cash is the idea. So that's an interesting thing. It's distributed, it's hard to censor, it's got incentive systems to keep the thing up. So this is why the BitTorrent is still around. And it can't be censored. So it's difficult to shut down because you basically have to go and shut down every single seed that's participating in this. And if that seed is located out of your jurisdiction, so it might be in a country that doesn't really care about copyright infringement, then you're stuck. Like the copyright holder is stuck. Yeah.
Couldn't you just shut down the tracker?
You could shut down the tracker. The other thing that MPAA, so the tracker comes and goes. And so that also can be run in different jurisdictions. So the MPAA did that for some of the more popular ones that were distributing, like if you have a popular tracker distributing a movie, you could go after trackers, but those things can go up and down so quickly that it doesn't make sense for the MPAA to go after the individual trackers. What made more sense for the MPAA to do, eventually you have to find the tracker. And the way people were finding a tracker was to go to a central search engine where people are registering their trackers to this search engine, and then people wanting to download something are searching for particular content. This is what Pirate Bay. So this is why MPAA went after Pirate Bay. This was the search engine for BitTorrent content. Okay. So this leads up to blockchains and cryptocurrencies, which are going to use different aspects of what we just talked about. The goal of a cryptocurrency and a blockchain is first, decentralized trust. You have a way of bootstrapping trust onto a network where nobody trusts each other, right? That's hard to do. The next thing that you want is a tamper-resistant ledger of transactions. So append-only, ordered log of authentic, immutable transfers. You also want the thing to be highly available and replicated. You don't want the thing to be shut down, like a Napster or some of these other services. You want the thing to operate with low overhead in terms of the computational resources required to keep the thing going, the amount of network bandwidth. You also want any transactions to this log to be low latency and have low costs for the person sending the transaction. If any of these things don't hold, you have a system that nobody wants to use effectively. You would also like anonymity. Well, if you're law enforcement, you might not want anonymity because the vast majority of transactions on cryptocurrencies is illegal, right? So this is a question mark, but if you are really concerned about your privacy, then yes, you would want anonymity for your transactions that prevent you from being tracked and traced. Your activity on that currency can't be traced. So more like what DigiCash was trying to do. Okay, and different blockchain systems will address these things differently, which is why we have so many blockchains out there. There are so many cryptocurrencies and blockchains out there doing tweaks on all of these things. And it depends on what this the blockchain flavor of the month is trying to support. Okay, so an initial version of a cryptocurrency was in 1998. It's called BitGold. And this was the proposal. It never got implemented, but the idea was to build a decentralized blockchain for digital currency. It was proposed by Nick Szabo. And when we get to Ethereum and you look at the units of currency in Ethereum, the Szabo is named after this. I mean, he has a unit of cryptocurrency named after him in homage to this particular system that he proposed, which was really influential. So the mechanics of BitGold was that a participant is going to solve a cryptographic puzzle that's difficult to generate currency. It's going to say, hey, I found this solution. I'm going to send it to some Byzantine fault-tolerant registry to accept my currency. And this is going to be a trusted third party, as it turns out, which is, not necessarily decentralized. The registry is going to assign the solution to that puzzle to the public key of the solver, of the participant that solves it. So this is using public key, private key cryptography to assign that currency. And then the accepted solution becomes part of the next puzzle. So you're going to mint currency serially sort of like a blockchain, and you're going to use the output of the current, the last solved puzzle as the input for the next bit of currency that you're going to mint. And then the majority of the parties in this registry have to accept that new solution before the next puzzle can be undertaken. So this limits inflation, and it also keeps that registry consistent, right? I have to make sure everybody agrees that that was the latest currency minted before I let anyone else tack on to that, okay? The next system is this reusable proof of work system. And this was developed by Hal Finney, and it was basically very similar to BitGold, except it got implemented. And they have, on GitHub, they have the code for this implementation there, if you want to look at it. So the ideas are similar. Participant solves a puzzle, signs a solution, and this is going to be referred to as a token. Signs it with its private key so that it can get credit for this solution. Publishes the token to a server, and the server will register that to the public key of the participant. So I've minted a token that I now own. The key thing with reusable is that now I can transfer this token to another participant by signing a transfer order with my private key, and I can say, I want to send this to a recipient, and I have the recipient's public key there. The server then registers the token. It takes it away from me and then registers that token now to the public key of the recipient. So this is where you're getting your transfer of currency from one person to the next. And this is basically a trusted third party that prevents double spending. So now that I've accepted this transfer, you're not allowed to send me another one that says transfer that token to someone else. So that's how RPow works. Okay. So this gets us, all of that stuff gets us all the way up to Bitcoin in 2009. So Bitcoin, the Genesis block was January 3rd. You can click on that link to see block number 0. If you click on it, you'll see block number 0 has a single transaction, and it has this thing called an output total, which is 50 Bitcoin. This is the miner's reward. So the very first transaction gave 50 Bitcoin to, the wallet is not there, but it gave 50 Bitcoin to, I think, Hal Finney. From Satoshi to Hal Finney was the, oh no, that was the first transaction. This was the first Bitcoin that was 50 Bitcoin that went to Satoshi. He mined it himself. And you can see the hash function. So that at that time, only 10 leading zeros were required to mine a block. And I think now we were like at 18 zeros were required when we looked at it last week. But you can see the previous block is all zeros because this is the very first block. And then the next block, so the hash is this, and then this is going to be the input for the block number 1. And block number 1 was mined, and its block ID is there. Okay. As part of this transaction, you can add message data in your transaction and then put that on the blockchain. The message that got sent was this chancellor on the brink of second bailout of banks, and it was dated January 3rd, 2009, and he did that based on a headline from that day on the Times. So this is a British newspaper, so then they were thinking, is it British or Australian? So when they go back and try and figure out who Satoshi actually is, this is like, well, he's got to be of this nationality because he had this newspaper on that day. So that's an interesting historical aside. I don't think any of this, so this, I believe this means that the thing hasn't been seen anymore. The Bitcoin that was mined hasn't been seen since. Okay, so the basic model of Bitcoin is to take all of the ideas I talked about earlier, decentralized systems where there's no central authority, hash chains for the chaining of transactions and the chaining of puzzles, RPow, so the ownership of a token using public key crypto. So it's going to leverage all of these innovations to build one system that tries to do it all. And it's trying to build a system that does consistent, distributed, peer-to-peer ledger of transactions. And this is the abstraction. The Bitcoin system has a whole bunch of participants that don't trust each other. They all store the same copy of this ledger. And the ledger, when Alice says, I want to send 10 Bitcoin to Bob over here, what you want to have happen is that everybody updates their ledger in synchrony to have this transaction. Alice is going to give Bob 10 Bitcoin. So that's the abstraction you want Bitcoin to give you. And of course, we're going to go underneath to talk about how. The first thing I wanted to show you was this idea of tokens. Just to visualize what you're storing on the Bitcoin ledger, you are storing token transfers, Bitcoin transfers. So this is what you would see on the Bitcoin ledger. You're not going to see balances of Bitcoin wallets. You're only going to see whenever certain wallets, like Darcy's wallet, is going to transfer to, who's this? Bingley's wallet. You're only going to see transfer transactions on the Bitcoin blockchain. Okay. If you want to figure out whether or not that transaction is valid, does Darcy have that money to actually give to Bingley? You have to replay the transaction log from the beginning of time to make sure that, yes, there's enough in that account for you to do that transfer. So this is the notion in Bitcoin of what they called an unspent transaction output. If I have a wallet address and it has been given transaction output from a previous transaction, so say I shipped someone a whole bunch of stuff and then they did a transaction to transfer a certain number of Bitcoin to me, but I haven't spent it yet. That is called an unspent transaction output. It's on the blockchain as Bitcoin sent to me that I have not used in another transaction to send to someone else. So UTXOs are basically what is stored on the Bitcoin blockchain. Okay? The main innovations of the Bitcoin network is that it adds the Nakamoto distributed consensus that we briefly talked about last class. The idea of this is that the consensus is based on the majority of participants accepting the longest chain of blocks as part of the ledger. You have to figure out what is the blessed version of the ledger, and the way the Nakamoto consensus works is that it just says, you know what, whichever has the longest length is the one I'm going to use. The construction of this chain requires a lot of CPU resources to get there. So you can't just mint chains and give yourself money easily. It's governed by proof of work to make sure that people can't just modify the chain. It also restricts the amount of currency. So some people, we had this discussion in Slack, some people view that as being a detriment to a currency system. But it's much like the gold standard. They wanted to go back to where you can't just mint money and then devalue. Like if I have Bitcoin, nobody can sit there and devalue the currency by printing more Bitcoin. And that is the kind of thing that many people want in a currency system, because they've seen enough of the governments printing money and then making their dollar worthless because they printed too much, or going in debt and printing money to address the debt, and then your cash is worth way less now. So this is unlike the fiat currency that we have most everywhere right now, where the supply is controlled by the central authority. Okay. Yeah. Mm-hmm. An algorithm does. And the algorithm is, the algorithm does, and the algorithm is trying to make the block time 10 minutes. So, and then the other thing is that the amount of currency you issue, new currency that you issue every 10 minutes is also fixed algorithmically. The only way you can get someone to mint way more Bitcoin is to convince all of the Bitcoin operators, the Bitcoin developers issuing the software, and all the nodes implementing that to upgrade to a different Bitcoin minting algorithm. So to mint more Bitcoin. And that's going to be really difficult because the reason people are participating in Bitcoin, a lot of the participants are doing this because the supply is fixed and it's predictable. Yes. Is there a question over here? No? Oh, yeah.
I was going to ask, how to convince a change to be made, but you explained you have to get like consensus from everybody.
Mm-hmm. And if there's a particular change that's really controversial, and almost 50% of the people want to do it, you'll see there's these things called hard forks. I'm going to create my own network. Bitcoin Gold. No, what? Yeah, Bitcoin Gold or Bitcoin SV. Bitcoin Cash. That's what I was looking for. These are, and we'll get to the history of all these things. You can create your own version of the Bitcoin network, and you can run it the way you want it. But then you would have to convince people to actually use that as legal tender, which again, people trying to rely on this as a currency, you have to look at how the thing is being run, right? Like, can I rely on these jokers developing the software and mining whatever? Like, that is where your trust is lying. Like, if they mess it up, there goes the value of your cryptocurrency. So if I don't hold any cryptocurrency, but if I did, I would have to basically research how easy is it for someone to go in there and subvert the system. Would be the thing, and hopefully by the end of this class you'll have some understanding of the risks involved when you're doing this kind of stuff. Okay, so let's go back to the Nakamoto consensus and look at this FLP and CAP result. So the FLP statement is consensus is impossible in an asynchronous network with a deterministic protocol. So what Nakamoto and the Nakamoto consensus and the Bitcoin consensus protocol does is that, this assumes that we want the thing to be consistent at all times. We're going to loosen the consistency requirements. So I want to support eventual consistency. And I'm going to do it in a mostly asynchronous network, or mostly synchronous network, I should say. So asynchronous, it does handle some asynchronous operation. And I'm going to do it with a randomized protocol. And this is the real innovation. This is someone thinking outside of the box, saying, hey, I want to do something that tweaks this idea in a special way. So in this system, you must have tight synchrony between all of the nodes. So all of the nodes, meaning all the people storing a version of the blockchain. You have to have tight synchrony between them in order to guarantee strong consistency. But upon a partition, so say the nodes with the blockchain are split apart, when you have that partition, the algorithm is to compromise consistency in order to make sure that the thing is still available to the people using it. Okay, so that's part of the CAP theorem. So the CAP theorem is consistency, availability in the face of a network partition. When the network partition happens, rather than sacrificing availability, I'm going to sacrifice consistency of the blockchain. So that should make you feel nervous, right? Like, no, I want to keep my Bitcoin. I don't want a bad guy to clip the cables between, Europe and US and then have me lose Bitcoin. But that's the trade-off here for this consensus protocol. So when a partition happens and it causes the blockchain to fork. So if you cut the network in half, each of these subparts of this network are going to continue to run the Bitcoin protocol. They are basically going to create their own versions of the blockchain. They're going to fork. And so there are going to be multiple chains that are going to be created from the forking point. So they were all the way consistent up until the partition, and then they're allowed to go off and operate on their own using whatever nodes are left over. When the partition eventually heals and these nodes are reconnected to each other, the algorithm forces the the partition with the shorter chain to abandon the chain. So half of the transactions are then just invalidated, and the actual consistent copy of record is the longest chain. So this is where you have temporary inconsistency, but eventual consistency, where you would adopt the longest chain. So that's the algorithm. Yep.
So how are the transactions not lost on the shorter chains?
They are lost.
Oh, they are?
Yeah, they're gone.
They're gone.
Yeah, no longer. Like, I'm not using that chain anymore. I'm going to use the other one that's longer. Yeah, they're gone. Yeah.
How's that not a double spending problem? Because if the transaction's no longer listed.
We'll get to this actually. Yeah, that's a security yeah, sure. Yeah, you can pull off a 51% attack to, create a second chain, start spending like crazy, getting all your goods, and then like, whoops, I have a longer chain over here. Everyone do that, and then I've gotten the goods. Yeah, we'll get to that.
Okay, that seems like a flaw.
Well, this is why I guess we're having this class, because now you understand how the mechanics act, and this is a trade-off that has worked, right? Because, well, how common is a network partition, and how can we reconcile from that? And it turns out for Bitcoin, the Bitcoin network itself, this has happened very rarely. For other altcoins, we'll call it, some people give it a less flattering term that's not suitable for me to say, but like these altcoins with a very tiny number of miners and with this longest chain, that can be subverted, and you could get a double spend. In fact, we'll get to double spending events that have happened. Did you have one? Yeah.
So I think the answer to that is if you have the split chain and you do transactions on one of the chains and it turns out to be the discarded one, you basically get all of your currency back to where.
If you have spent it, yeah. But if you have received it, you've lost it, yeah.
Any currency you receive on the shorter chain and currency you spend, it reverts back to before the split.
Yes. Okay, so longest chain is always accepted by the Bitcoin nodes, and that's just programmatically in the network itself. And then this gets to your comment. Any valid accepted transactions on the shorter chain now become non-existent. They're invalid, basically. They fall off the ledger. They're no longer part of the ledger that people are using to determine how much money you have. Okay, so this is not acceptable to financial institutions, right? Financial institutions need to know that that transaction has happened for them to then do another transaction or other things, okay? This is why financial blockchains are using something else for their consensus protocol. This is why there's all that BFT stuff and all the strongly consistent agreement protocols that will drop kick availability whenever there's a partition. Like, I don't want anybody to make any progress when there's a partition to ensure consistent state. Okay? Yeah. All right, so now we're going to go dive into the details of this thing. The first thing we're going to talk about are transaction mechanics. And we've already covered this using the cryptography stuff, but I want to give it to you in the context of Bitcoin. So in Bitcoin, the wallet address is basically your public key. And again, it doesn't hold Bitcoin like the other DigiCash systems might have. It's actually it's used to sign transactions. So the wallet is basically, the only thing it has is a private key that allows you to do transfers on the blockchain. So there is nothing stored per se in terms of cash in your wallet, which is sort of makes it a misnomer. But it is a private key that you're protecting in the wallet. So this is a picture of this. You have your public key, which is in blue, which is your wallet address, and then your web wallet. So when you bring up your MetaMask account, which is going to have your wallet, it's got the private key that allows you to sign transactions on behalf of any of your public wallet addresses, is what's going on. Okay. All right, so any new transactions that you want to send into the network, that are created by your wallet, is signed by the private key. So you have a private key that's in your wallet. The public key is the address. So say you want to spend some of your UTXOs. You're going to sign it with this private key and then send it into the network for execution. The nodes are going to use the wallet address, which is the public key. So these are the addresses that you have used in the past. This is the address that you have used in the past to receive transactions, to receive currency. They're going to use this wallet address to verify that, yes, you actually signed this transaction, because your public key is your address. And then what the sender is going to do is going to create this transaction. It has the private key and public key of the sender. And then you want to send this, you want to sign a transaction that says, send some money to a recipient. And so all you have is the recipient's public key, which is this blue key sabar. And then you're going to use your private key to sign a transaction that says, send X amount of Bitcoin from this public address to the recipient's public address, from my public address to the recipient's public address. And you're going to sign it with your private key so that when nodes see this transaction, they can use your public key, your wallet address that you have just disclosed here. They can use this to validate the signature on this message. And then if that actually is going to check out, then this is still a candidate to be included in the next block. You haven't done anything in terms of committing this to the ledger. You're just validating that, yes, this is a valid transaction. The public key, private key works out. And so this is done. So the next thing that has to happen is that a node has to go and see, well, how many transactions has this address, the sender's public key, received? Like if you're going to try and spend 10 Bitcoin, the node has to go back into the ledger to make sure you have access to 10 Bitcoin, that you have 10 Bitcoins worth of unspent transaction output. And then if you do, it says, okay, this is a transaction that I can then commit to the ledger. This is a little bit of a more detailed picture of what's going on. So here we have a transaction that goes from B to C. And as part of this transaction, I want to have transactions that are precursors to this that feed into B's balance in order for B to then take that and then send it to C. So we're gonna talk about what happens, the mechanics of what happens when B wants to use the private key to sign the transaction to C. So the first thing that happens is that it indicates the public key from which the UTXOs are transferred from. So this is B's public key as part of the message. And then it indicates the public key of the recipient. So in this case, I want to send it to C. And so this transaction has B's public key. It has C's public key as part of the address. And then what happens is that everybody is going to verify that B's private key did in fact sign. So B is going to sign this thing. And then everyone's going to verify that these things match, that this signature is signing is an appropriate signature to this transaction. And then you're going to examine the ledger to make sure that B has access to these unspent transaction outputs. So then you're going to go back up the chain to make sure that it was a recipient of that UTXO. And then if that's the case, everything checks out, the signatures check out, the ledger balance checks out. Then I can actually include this in the next and I can try and include this in the next block for the blockchain to record. Are there any questions about the mechanics of transacting? Okay. So the standard, the Bitcoin public and private keys, is basically this BIP39 HD wallet. It's a library of 2,048 short words. And then you pick 24 words randomly out of this library of words, and that's your private key. That is used to generate your private key. And there's enough entropy here for you to get really strong keys, while making the actual key itself something you can read, right? It's not something like F3D0B. So it's not like that. These are actual English words, 2,048 of them, so it's hard to mistype your private key. So this is what they're doing. And when you set up your MetaMask, you'll see that the recovery seed phrase is basically adhering to this standard. And then, so the entropy that you get is 2,048 short words. Well, if you select randomly 24 times, this gives you 2048 to the 24th power, which is basically 2 to the 264. So this is like 264 bits of entropy in your private key, which is a pretty strong key. And hopefully quantum computers don't get at that anytime soon. The words are then hashed. So your 24 words are hashed to create your root private key, and then that ECDSA produces the public key from that private key, and then the public key is being used as your address. So that's the mechanics of the wallet. The next thing that happens, so say I validated a bunch of transactions that I want to now submit to the ledger to make sure that it's part of the public record. So the transactions are sent to a full node. So your wallet knows about all the full nodes running the Bitcoin blockchain. So now you're going to say, here are some candidate transactions that I want you to approve and commit to the ledger. It's sent to this thing called a mempool. And this is a global pool amongst all the nodes that are candidate transactions to include for the next block. Okay? Typically, these transactions have fees attached to them because you want to be able to reward both the full node and the miners with some fee, some money, so that it keeps the network operational, right? Like you want to be able to pay their electric bills is effectively what's going on. And so all of these transactions have a notion of a transaction fee. And the wallet algorithm is attempting to guess what the optimal transaction fee is to get your transaction into the next block, right? So if it looks at the previous transaction fee, the average transaction fees in the previous like 2 or 3 blocks, and it says, wow, 0.05 Bitcoin is needed per transaction in order for it to get reliably placed into a block. I'm going to put that as my transaction fee in order to try and get that into the block. And you'll see when you work with your wallet, you can actually you can raise or lower the amount of transaction fee that you want to have associated with your transaction in order to get the thing done quicker. So you'll see there's a lot of waiting around on the blockchain to get your transaction through. So if you want to not have to wait, you would just crank that thing up. Okay, but this is going to lead to spikes whenever the demand is high. So this is the number of transactions in the mempool. No, this is the amount in fees for a transaction. So you'll see in 2017 it was about 200. Oh, this is an aggregate. This is not for an individual transaction, but the amount in transaction fees that were being accrued in the network over time. And you can see there's this huge spike in January of 2018. And this is what this spike in transaction fees caused one of the developers of Bitcoin to say, I've had enough. I'm going to fork the Bitcoin network into my own thing that addresses this transaction fee problem. And so this is where one of the splits happened in January 2018 to address the fact that people couldn't transact on the network because the fees were too high. Okay. The thing with the mempool is that if you send a transaction in there and you don't put enough of fees for it to be included, it's going to sit in that mempool for a while, taking up state. And so with the mempool, there's a 2-week timeout. If you're there in the mempool for 2 weeks, then the mempool is going to automatically drop your transaction. And this is a picture of the size of the mempool in terms of number of transactions. And so this is also undesirable. This is from, when is this from? This is from earlier this year. If you look at the number of transactions in the mempool, it's up here at close to 70,000. 70,000 transactions are trying to get onto the blockchain, but are stuck in the mempool. at this point in time. Okay? And you can click on these links to get the actual latest version of this. This is from Spring. Okay, so when you have all the candidate transactions that you can include into the next block in this mempool, then the next thing that happens is that a miner is going to look at that pool and it's going to say, you know what, I am going to collect up a bunch of transactions and I'm going to try and create a block from that. I am going to try and solve the proof of work puzzle on those transactions so that it can be added to the blockchain and I can get a mining reward. And it's going to go through these transactions, and because it wants to maximize the amount of money it gets, it's going to prioritize all the transactions with the highest fees. So that's what it'll priority order the mempool based on a transaction fee, and almost all the miners are going to do this. So they're all likely going to solve the exact same block, or the exact same transaction set. So this is what happens. You have a wallet. The wallet issues new transactions. The full node gets these transactions, and then the mempool is here. The miners will take things from the mempool and will either solo mine it. So if it's a single miner, it's a solo wallet that's doing the mining. But more often than not these days, you're part of a mining pool. And the mining pool is going to distribute the proof of work puzzle so that people are using different spaces of the nonces to try and solve the puzzle. You can divvy up, because it's a nonce that you're changing, you can say, you do the first billion, I'll do the next billion, and so on in the mining pool. And then the first person with the solution will then broadcast that back up to the mining pool. As part of mining, the miners have to associate a wallet address that will receive the block reward whenever it has successfully mined the transaction. So this is where the miners make money, right? Like, I have a successful block, it's got my wallet address, and that's my wallet address so that the transaction can get updated in the log. Okay. Are there any questions about mining and how that thing is done? Okay, so then miners organize as a pool often, solve this proof of work puzzle based on the hash of the prior block, the hash of the proposed block containing the transactions that it had selected, the difficulty that was specified algorithmically by the Bitcoin software, and then it finds the nonce that results in that partial hash collision as shown earlier with a bunch of leading zeros. As soon as a miner gets that puzzle solution, it broadcasts it to all the full nodes because it wants to claim that Bitcoin as soon as possible before someone else does. And then the full nodes are going to validate that it was a successfully mined block. They don't want to admit invalid transactions into the block. So if the miner inserted a bogus transaction in there and sent it back to the full node could be admitting, the bogus transactions into the blockchain. So the full node has to validate all of this stuff, and then it will immediately accept a valid block and move on to the next block. Okay? And at this point, as soon as miners see that a new block has been added, they will abandon their proof of work computation because they want to go try and solve the next one. They are racing because it doesn't make sense for them to continue to mine the current block if a block has already been established. The chances of you getting a longer chain have gone way down unless you move directly to the most up-to-date block. Okay. So I mentioned earlier about the fees. How do the fees work? So everything is these UTXOs on the blockchain. So how do you say, I want to give a certain amount to whoever mines this block? This is a picture of what's going on. Say I have a new transaction as a wallet, and I know I have previously received 3 Bitcoin here, 2 Bitcoin here. And so if I have a new transaction that says I want to send 4 Bitcoin to Bob, and then I want my change back, 0.5 Bitcoin, but I know I need to spend 0.5, then I have this in my transaction, and anything that's left over will get sent to the miner as a transaction fee. And that's how the UTXOs work, so that you can pay the transaction fee over to the miner. Okay, the next thing about mining is the coin base. So the miner gets there's a notion called the block reward. Anytime you submit a valid block to the blockchain, the miner that does that is awarded currency, and that's the block reward. This is called the Coinbase transaction for that particular Bitcoin that gets minted on that block. The reward was initially 50 Bitcoin. So you saw earlier in that picture, block number 0 had an output of 50 Bitcoin. That is the mining reward on that first block. This is where they control the supply of Bitcoin. Every 4 years, this thing is cut in half. And this is why they know that by 2147, there will be no more Bitcoin that will be produced. And instead, miners are just going to get rewards based on transaction fees. So this doesn't mean that the whole Bitcoin network is going to fail in 2147. This just means that the amount of currency will then be capped at that point. And I think like the 80 or 90% of the Bitcoin has already been mined. 85%? Okay, so this is a demo of what actually goes on. So one of the things on this previous example was that if you look at this first block, how do I know in the first block, the origin block, that these people have access to this money? You don't. There's no Coinbase. There's no origin of this money. So this is technically not a legitimate ledger because you don't have where did the money start? How did this person get the $25? And so a more realistic picture is here. And this is what you'll see on the Bitcoin blockchain if you follow it from block 0. You have the origin block, which is always the block that only has a Coinbase transaction. Whoever successfully mined this, and in this case Anders, the author of all of this software, says, I am awarded $100 or 50 Bitcoin if it was Bitcoin. And then from this Coinbase, Anders can then take this money and then distribute it to all of the other folks that he wants to distribute it to, and he can mine another $100 for this block that goes onto the blockchain. And then further on, Anders doesn't have to be the only person that does this mining. So now we have transactions with a Coinbase. Now you can have other people do Coinbases. So in this case, Sophia. And this is where money gets injected. And now you have a consistent ledger that goes all the way back to when that money was minted that's reliable. So that's the fuller picture of what Bitcoin is doing. Are there questions about that? Yeah.
Actually, on the previous 2147, there was stopping new Bitcoins.
Yeah.
Assuming that this is a concern, even though it's far off in the future, eventually there aren't going to be access to any Bitcoins left, or the access will be very, very low for how many Bitcoins you have.
Yeah, that is definitely correct. I don't know what you could fork, one day you could fork the blockchain to change the algorithm, and Bitcoin has been forked multiple times already. So that would be one way. I don't know. The way Bitcoin, the management of Bitcoin is so distributed, like getting consensus on what to improve is much harder on Bitcoin than it is on things that are a little more centralized, like Ethereum is sort of, Vitalik is sort of got a lot of clout. So and we'll talk about that's good and bad, right? There is some power that is centralized on the Ethereum Foundation. You don't have that as much on Bitcoin, which is why it's a safe haven for people who have gotten Bitcoin illegally. Like, they know that it won't be taken away from them. So yeah, these are, good. I don't know the answers to those at all. Okay. Okay, so I talked about this as well. The longest chain wins. You can only profit by mining off of the latest blocks. So if you are a miner and you start mining blocks that eventually fall off the chain, then you've lost all of your work. So this is why as soon as, if both of these are minted, well, if this thing is minted first, rather than create B2 that's also part of this, a miner would have the incentive to switch over almost immediately, because then the chances of you being able to build this chain that outpaces that is lower. So that's why the longest chain algorithm sort of supports a movement towards consistency, and it's done by an incentive system where like you don't have the incentive to keep this thing split. You have the incentive to go to the longest one, and that lines up everyone really well in this case. Okay. Okay, so this leads, on Bitcoin, there's this thing called confirmations. And this is also a term that's also used as block depth. This is the number of blocks that have reconfirmed your block as part of the chain. So really, these forks in the blockchain, there can be some that are very temporary. So if two miners get the exact same, get a solution at the exact same time, and they publish these to all the full nodes simultaneously, then there's a short period of time where miners are confused. They're like, which one do I accept? Which one do I now mine on? So you will have the case where there are ephemeral forks in the blockchain, and then they eventually get reconciled. So you as a consumer, like if you are transacting on the blockchain, you want to wait until your block is sufficiently far away, where sufficiently deep, meaning that there's multiple blocks after it, so that you know that you're not subject to falling off the chain, right? Like in order for you to have confidence that you're not going to fall off the chain, well, if I'm all the way upstream and there's like at least a dozen blocks after me, then I can be sure, okay, it's going to be unlikely that someone's got a side chain that will cause me to fall off the blockchain. Okay. So typically, you would wait 3 or 4 confirmations to ensure that you're not going to get orphaned off of the chain. But this is like a 40-minute transaction delay. Who wants to try and buy something and then wait 40 minutes to get out of that store because your transaction is deep enough that it won't get undone? Like maybe a store can be like, okay, chances are it's going to go through, so I'll give you the goods without getting the confirmations from the blockchain. But really, this is a problem, right? Like this is not good for microtransactions, where you're trying to do small amounts of transactions in near real time, is the idea. Okay, so I'm going to talk about different aspects of the Bitcoin design. The first thing was it was designed for decentralization so that anybody could participate. And this is very much like BitTorrent and Nutella. And the way they did this was to say, hey, I'm only going to allow 1 block every 10 minutes. And one of the things this gets me is that the size of the full node now grows linearly. It's not going to be exponential. So I have a predictability of the size of that blockchain. And it's currently only 200 gigabytes. And yeah, like one of these micro SD cards can actually store the entire Bitcoin blockchain. And you can store this on a Raspberry Pi if you'd like. So this is the size of the Bitcoin blockchain over time. It's a nice straight line, which is good for technology, right? Like we can deal with that in terms of supporting that rate of growth. But this is limiting the transaction rate. This is why you have to wait so long in order to get your stuff through. And this is the number of transactions over time that are being pushed through the Bitcoin network. And if you look at this, it's like several 100,000 per day. If you think about a credit card network, there's more than several 100,000 credit card transactions being done every day. This is not going to be able to replace that, is what we're doing. So 7 transactions per second is the transaction rate. At its peak, the Visa network needs about 2,000 transactions per second. So we're basically 3 orders of magnitude away from being able to do this kind of rate. Oh, actually 50,000 is the peak. 2,000 is the average. So yeah, we're not anywhere close. The other reason the thing grows slowly is to control the rate that the blocks are added to maintain consistency. And we talked about this earlier. The propagation time for the blocks to be replicated have to be much less than the time between the time to create new blocks. And this is to avoid the double spending problem. So this drives this proof of work difficulty. So the number of zeros in the hash at the beginning is changed every 2 weeks. And what they do is they look at the amount of time between blocks. And they take an average, and if the average number of time between blocks is below 10 minutes, then it adds more zeros. If it's above 10 minutes, then it will decrease the number of zeros for the puzzle to be solved. And that allows you to dynamically tune the difficulty to address advances in hardware effectively. So this is the plot of the difficulty of the puzzle over time. And you can see it's sitting here matching the advances in hardware to solve the hash puzzle. But then you have something that looks like this. And this happened towards the end of 2018. So what happened here? Does anyone know? Maybe, I don't know actually. Yeah, this was the cryptocurrency winter from November. People were like, oh God, this is a house of cards, I'm gonna get out. And so a whole bunch of money came out of the Bitcoin. Like people were getting rid of their stuff and then they were not transacting anymore. So this was the crypto winter, which I think we're sort of recovering from. I haven't checked the latest price. And the big thing was a whole bunch of miners decided it was no longer profitable to be mining Bitcoin. So they basically shut those things down. Because you're paying electricity, you're paying the hardware, you're paying the people to manage the thing. If you're not getting consistent Bitcoin as a reward, and it's not paying the bills, you got to get out. And that's what these folks are doing. And in fact, they were taking their rigs and trying to do like third-party sales of it. Like, hey, here's my hash puzzle card hardware. Like, who wants it? Put it on eBay and see who wants to run a miner. This is an interesting figure. This is the mining profitability chart. And you can see in this is from 2018 to 2019. All of a sudden, in November, mining became unprofitable. And so people got out of the mining business. Okay. The next thing I want to talk about is security. So authentication is done using the private key, public key cryptography. And this allows the accounts to never be disabled because, well, unless you actually compromise the private key. And then you can disable the account and steal all of the money. But it also forces the user to be responsible for his or her private key. And how many of you trust yourself enough to keep that thing secret? I know I don't. I'm like, I like lose things so often that I'm like, I don't want anything that costs me money. You know, maybe $1 or $2. Like, okay, whatever's in my wallet, my physical wallet, that's about as much as I can trust myself with. But yeah, I would rather have a credit card that I can lose than money, cash. And this is cash. As soon as you lose your private key, that is cash that you've lost. So if you put thousands of dollars into your cryptocurrency wallet and you lose your private key, that's thousands of dollars. So you need good operational security. And most people, including myself, don't have good operational security. And then you have things like this. So XKCD got it right. It's like, yeah, if somebody uses a wrench to beat your password out of you and gets your private key, there goes all your money. So, okay. The transactions are pseudo-anonymous, so you can trace the wallet address all the way through time. So you can link transactions to each other on Bitcoin, but yeah, you're not actually giving your IP address, you're not actually giving any identifying information in the transaction, it's just that private key that's signing them. But But that's enough information for people to try and trace transactions and to attribute transactions to particular wallets. And then if they are able to confiscate a computer that you have that has potentially your private key in there, then they can attribute all of those transactions to you. And so this motivates things like Zcash. So there's all these anonymous cryptocurrencies, and the idea of all of them is to try and create a pool where people pay into the pool, the money in the pool gets shuffled around, and then people get paid out. And so this obfuscates who the payer and the payee are in that transaction. And so this is something, if you want to do more reading, there are links in that list of papers that I linked off of the site on anonymous cryptocurrencies. But 90% of Zcash usage is done to support illegal activity. So this is one of these things that law enforcement is going to have to struggle with in terms of tracking this. Okay, another nice thing about this is that it resists the Sybil attack. So we talked about BFT protocols where you need at least 2/3 to be good, non-malicious. Well, here you force an adversary to gather a whole bunch of mining resources or to break public key cryptography in order to subvert the system. And so this allows it to resist that Sybil attack because it doesn't make sense to create a bunch of wallet IDs if you don't have the hardware to try and subvert the network. Okay. But there are attacks where they try and subvert the network with CPU resources. This kind of 51% attack is what we'll talk about later. Okay, the next thing is scalability. So the current implementation is difficult to use just because of the 7 transactions per second. So there are some proposed alternatives to this. The first one is Litecoin. This is a code fork of Bitcoin, and it uses a different puzzle. It uses something that's memory bound. So this is interesting because it makes ASIC mining really difficult. If you have a memory bound puzzle where you require a bunch of RAM to solve, that puts the resource into something that's a little bit harder to just scale up. Okay. The block time of Litecoin is much smaller, so that it gives you a better transaction throughput, and then it's got the same block reward and the same block size. Bitcoin Cash, which we talked about earlier, this was a hard fork of Bitcoin. This is from, I think it's Craig Wright, who wanted the number of transactions included in a block to be bigger, so that he wanted a 4 megabyte block size to get lower transaction costs. And he abandoned the notion that full nodes have to run on embedded devices. Almost no full node on the Bitcoin network runs on an embedded device anyway. And then this is eventually forked into Bitcoin SV for other reasons. Okay, there are people who are trying to scale up Bitcoin in place. And the idea of that is to do this IOU system. Like to do a temporary sort of transaction where it's like a bunch of people saying IOU to the committer, to the person with the wallet, and then at the very end of the day, that gets committed in a single transaction on the Bitcoin network. This is very similar to opening up a tab at a bar, buying a whole bunch of stuff, and then closing it out at the very end and sending one transaction to the credit card company. So that's what they're doing. And that's what the Lightning Network is proposed to do. I think that's actually deployed now. But that's one way to get around this, is to use some other settlement system to aggregate all the transactions into a single monolithic one that's got all of them in there. Okay. Another approach is to create a whole bunch, it's similar, is to create a whole bunch of side blockchains and then sync those block hashes onto the main chain. So you're just using the main chain, and this won't be for Bitcoin, but this is for some of the other cryptocurrencies. You create a main chain that all it does is store hashes, and then hierarchically you're running your mini blockchains, and then you're just committing the hashes of the mini blockchains, which have all the transaction data in them, onto the main blockchain. And then you're using the commitment to the hashes to validate your chain So that's another approach that's being pursued. Okay. So I am going to end there. Are there any questions about Bitcoin? We won't be using Bitcoin a lot in this class because it's pretty straightforward. And they don't have a test network as Ethereum does. So I don't want anyone to put any money in this class and have it be lost. All right, that's it. I'm going to pause here.